Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. With me for our Beyond the News interview is Esme Denice, Tax Technical Coordinator at IBFD in Amsterdam. On today's show, will the United States' groundbreaking proposal on Pillar 1 lead to consensus at the OECD? Uganda targets beneficial owners, doubles fines and penalties, and gives tax authorities the power to make arrests. And cryptocurrencies contribute to a record U.S. tax gap, and it's a whopper. These and more, including Esme Denice's interview with Francesco de Lillo, Senior Associate at IBFD in Amsterdam, coming up on Tax Takes. First, we turn to the top news of the past week as reported in IBFD's Tax News Service. American politicians are fond of saying that elections have consequences, but it's hard to imagine that the election of Joe Biden would have such profound consequences on the course of international tax reform, particularly during his first 80 days on the job. When Biden took office in January, he promised to deal first with the pandemic and rebuilding the economy. But even the most optimistic observers could not have imagined his administration diving headfirst into the nearly 8-year-long international effort to tackle base erosion and profit shifting. And yet here we are, with Treasury Secretary Janet Yellen taking bold steps to meet the OECD's July deadline for reaching a deal. First, she abandoned the U.S.'s safe harbor proposal on Pillar 1, a non-starter left over from the last administration. Then she brought on board a team of experienced tax professionals, including Kim Clausing and Itai Grinberg, to engage with the OECD. And just last week, she presented a proposal to narrow and simplify the dizzying array of competing proposals on Pillar 1. Among other things, the U.S. proposes to limit the reach of Pillar 1 to the biggest, most profitable companies, regardless of business sector or domicile, about 100 in all, while imposing a robust global minimum tax. If international reaction is any guide, the odds may have swung in favor of reaching consensus this summer. Uganda has become the latest country to go after treaty abuse through beneficial ownership. Under its amended budget set to take effect on July 1st, the government has expanded the definition of beneficial ownership while doubling fines and penalties and giving tax authorities sweeping power to make arrests and close businesses. At the same time, the country will provide significant tax incentives for new manufacturing businesses while imposing a new levy of $200 per kilogram of gold exported from the country. Talk about the carrot and the stick. China is taking the carrot approach to support businesses. It recently announced an increase in the so-called super deduction for R&D expenses from 175% of the investment to 200%, retroactive to the beginning of this year. On top of that, China has also announced a significant cut in tax rates for small businesses and sole proprietorships. The Scottish poet Robert Burns wrote about how the best laid plans of mice and men often go astray. Though he wasn't writing about tax compliance, his lesson applies nonetheless. Governments will always expect to collect more in taxes than taxpayers actually pay, with the difference between expected revenue and actual revenue representing the tax gap. As recently as 8 years ago, the U.S. estimated its tax gap at about $300 to $400 billion per year, mostly from noncompliance, hidden assets, and fraud. While that number pales in comparison to the latest estimate, IRS Commissioner Chuck Rettig recently told a congressional committee that he now estimates the U.S. tax gap to be a whopping $1 trillion per year. The latest culprit? The growing use of cybercurrency, much of it still unreported and undetected. And now moving on to other news. As part of its follow-up work on the BEPS project, the OECD routinely monitors the progress that members of the inclusive framework are making to implement the recommendations. In its latest report, the OECD examined how 8 nations are using the multilateral instrument under BEPS Action 14 to resolve treaty disputes. The OECD gave the 8 countries high marks, noting that Israel, New Zealand, and Portugal had reduced the time they take to resolve mutual agreement procedure cases. Following the lead of countries around the world, the European Commission has proposed to exempt from taxation the importation of goods and services designed to fight the COVID-19 pandemic. The proposed exemption from VAT covers a wide range of services and equipment, all the way from personal protective equipment and antibiotics to life jackets, sandbags, and search and rescue equipment. If adopted, the tax exemptions would take effect retroactively to January 1st of this year. And finally, as we reported last week, Kenya's new 1% minimum tax faces a court challenge from businesses that claim the tax is discriminatory and unconstitutional. One business that will not be challenging that tax, however, is Kenya Airways. That's because the cabinet secretary recently exempted from the minimum tax any airline and subsidiary which is at least 45% owned by the government. And the Kenyan government owns about 48% of the troubled carrier. Coincidence? I think not. And now we go beyond the news for Esme Denise's interview with Francesco de Lillo. Esme.
Thank you, Stuart, for your informative news report. I'm Esme Denijs, Tax Technical Coordinator at IBFD, and with me here today is Francesco de Lillo, Senior Associate at IBFD. Welcome, Francesco.
Thank you, Esme, for inviting me here. It's a pleasure.
Well, thank you so much for being here with us today. Before we dive into the debate on Pillar 2 and discuss the recently launched book on global minimum taxation, which you co-wrote, could you briefly explain to reviewers your field of expertise and position at IBFD?
I am a senior associate within the IBFD European Tax Knowledge team, and I'm responsible, among others, for online courses on current developments and managing editor of the IBFD holding companies collection. My main research focus is indeed anti-tax avoidance policies and measures, and that's why for me it was quite an interesting opportunity to contribute to this book.
Yeah, well, let's dive directly into that book and talk about the Global Minimum Taxation Analysis of the Global Anti-Base Erosion Initiative, which was launched in March this year. Could you tell our viewers what does it bring to the table, and especially with the members of the BEPS Inclusive Framework aiming to reach consensus on global minimum tax by this summer?
Well, the book offers an in-depth analysis of the Pillar 2 proposals as outlined in the blueprint issued by the OECD in October 2020. The book covers not only the design aspect and the technicalities of the 4 proposed global rules, but also consideration on broader policy aspects such as the implementation and the coordination, the interaction with tax treaty and the current TPA rules, the special EU law framework, and also the perspective of developing countries. Being published at the beginning of March 2021, I believe this is the first book entirely dedicated to the topic and based on the latest documentation released.
Right, so it's a very good addition to what's on the table right now when we're talking about scientific research papers, and for that matter, definitely something to check out.
Indeed.
Well, apart from all the implementation side of things and possible EU framework compatibility issues or not, something that continues to float is the global minimum tax rates. Where do you think it will land, if it will land at all?
Well, the determination of the global minimum rate is for sure one of the key elements of the overall project, which aims indeed at ensuring the imposition of a minimum level of tax on the global profits of multinational enterprises, thus reducing the marginal gain from profit shifting and putting finally an end to the race to the bottom. Minimum rates of taxes are not a novelty in the international tax framework. Many states, especially developing jurisdictions, provides for alternative minimum tax regimes, where the minimum tax rate is usually set at a very low rate in between 0.5% and 2%. Additionally, CFC rules, or the US GILTI, providing taxation of foreign under-tax profits, are examined as comparable ideas to GLOBI. Nonetheless, in all these cases, the determination of the acceptable minimum rate of tax is a unilateral and individual choice based on specific policy goals and concrete revenue needs determined by jurisdiction unilaterally and individually. Transposing such an idea to the global framework triggers the question of which are the criteria and the metrics to be used to determine this global minimum rate of tax. For sure, also equity plays an important role in such a process. But the question then is how to express in a percentage the underlying equity concern to the overall Pillar 2 project.
Right. Well, you mentioned something very interesting there, and that's the guilty rate, which would be an interesting benchmark considering the Biden administration recently proposed to double the rate from 10.5% to 21%, meaning that quite some statutory rates would fall below that rate. For instance, Ireland has a statutory rate of 12.5%, Singapore 17%, and Saudi Arabia 20%, to just name a few. Would such a high rate fly?
Well, for sure, the recent proposals of the Biden administration will have an impact on this process of determining the global minimum tax rate. As recently also stated by the current chair of the OECD Committee on Fiscal Affairs, Martin Krayenbaum, it has to be seen, though, to which extent. If the choice of an excessively low rate would ultimately risk to nullify the overall objective of the initiative, the choice of a high minimum rate of taxation might have disruptive effects in terms of tax neutrality and investment location. In this context, additionally, we need to consider also tax holidays or other tax incentives that usually developing countries provide offers to incentivize foreign investment. Additionally, we should not forget that in 2019, the average statutory corporate income tax rate was 24%. But if we take into consideration preferential tax regimes such as IP or patent boxes too, this average rate drops at least by 9 points. Therefore, it has to be seen the full extent to which the Biden proposal will actually influence the determination of the global minimum rate.
Right. So that's still a lot of guessing there. And you touched upon such an interesting point about the inclusive framework, especially with regards to developing countries. For the matter, it's questionable whether they will benefit from the Pillar 1 and 2 proposals, not to mention the enforceability of the proposals. We also see quite some inclusive framework countries taking the initiative in their own hands by implementing unilateral measures. You already mentioned minimum taxation in developing countries that have a very low rate compared to what's recently discussed about the guilty, but also just the digital service taxes being implemented around the globe. Therefore, looking towards the future, what would you think the outcome would be? Do we reach consensus by the summer? Do we not? Or perhaps partially?
Well, I honestly think that a higher level of consensus might be reached, especially following the recent statement of the US Treasury Secretary, Janet Yellen, which essentially expresses the full commitment of the US to the Pillar 2 project. However, I suspect that the way is still long and further work will need to be carried out within the inclusive framework. First of all, the technicalities of the project are extremely high and challenging. So there's also a discussion of capacity, of course. And second, one of the key takeaways of the book is that even if we imagine that the full consensus is reached within the inclusive framework on all the design elements and all the technical aspects of the rules, the implementation process actually entails an additional set of challenges and an additional set of multilateral effort required that is quite difficult to put into reality. For this reason, the OECD recommend adoption of multilateral soft law and hard law tools, such as a draft model legislation, a peer review process, and even a new multilateral instrument. But on the other hand, I think it's quite an unprecedented effort in terms of international cooperation. Therefore, I'm quite curious to see what is the outcome.
Well, I'm with you. I think we all are, including our viewers. And whatever the outcome might be, it is clear that there's still a lot that needs to be mapped out, which you can read all about in the book Global Minimum Taxation, an analysis of the Global Anti-Base Erosion Initiative. And that's all, unfortunately, that we have time for today. Our guest today has been Francesco de Lillo. Well, Francesco, thank you very much for your time and sharing your views on global minimum taxation.
Thanks to you, Esme.
And that wraps up this week's episode of TaxTake's News in View, the week's tax news in a nutshell. Due to King's Day holidays in the Netherlands, we won't be hosting a show next week. We will, however, return in 2 weeks with a new show and a new guest. From Stuart Gibson and myself, thank you for watching, and here's hoping your week is not too taxing.